Ever wonder how the rich built their multi-billion-dollar empires? Well, it's through a well-known formula that has been in use for centuries. It has everything to do with asset accumulation. But what assets do they buy? Let's explore 10 different assets that the wealthy accumulate to generate huge amounts of income and wealth. You might be surprised by the last asset. Stick around to the end. Number 10. Real estate. This one is talked about at great lengths by just about everyone. The idea of buying up real estate is to rent out property for regular income. People need a place to sleep at the end of the day, and most need some kind of office or workspace to do their work. Buying up real estate, such as residential or commercial properties, can generate huge amounts of monthly rent for the owner, shoring up their income needs. Owners can also benefit from the appreciation of the property, resulting in increased value if they decide to sell. Real estate is not without drawbacks. Two of the biggest concerns with real estate is the maintenance on properties. An increase in maintenance costs can eat away at your revenue, leaving you with less profit. Another thing to consider is the fact that you may have to deal with a vacant property, sometimes for a long period of time. If no one is there, you can't get rent payments. Even with these significant drawbacks, real estate is still a popular choice by many to grow their wealth. Number 9. Stocks. Stocks are arguably the most well-known way to build wealth, as the barrier for entry is much lower than most other assets. All it takes is to open a brokerage account, fund it, and you can start investing in the stock market in as little as a few business days. Not only are stocks easy to buy, but they are an attractive option for earning capital gains and dividend income, making them a versatile option for your investing needs. Want to diversify your stock investments, or don't want to do research into buying different stocks? Mutual funds and ETFs can provide a great alternative way to invest that doesn't require a lot of input from your side. Now, there are drawbacks with stocks and related investments. They make up the stock market, which is unpredictable and volatile at times. This can result in increased stress, as well as potential drops in your portfolio. This unpredictability is due to the economics around the world, as well as the individual company performances. While there are risks involved with investing in stocks, the potential for gains and income cannot be understated. Number 8. Bonds. A bit tougher to get into, as bond markets aren't as accessible as stock markets. That said, bonds can provide a good source of steady interest income, especially if stable government bonds are purchased. A major perk to bonds over stocks is that they are generally more stable than stocks, as they are susceptible to interest rates rather than company performance. They are a more stable source of income as they collect interest consistently. Bonds, however, are not without risk. As mentioned, they are affected by the interest rates. As rates increase, bond values go down. As interest rates fall, bond values go up. There's also the possibility that the entity issuing the bonds go down. While you have more rights to the assets at bankruptcy versus a stockholder, you may not even get what you're owed if the amount owing to the other creditors is significantly higher. Even with the risks involved, bonds are a great way to bring steady income and portfolio value to your overall investment strategy. Number 7. Retirement accounts. While these accounts in and of themselves don't have monetary value, what they bring to the table cannot be understated. Here in Canada, we have two main types of retirement accounts: Registered Retirement Savings Plans, or RRSPs, and Tax-Free Savings Accounts, or TFSAs. These accounts allow you to contribute a certain amount each year, and those accounts can grow in a tax-sheltered environment. Any gains that they make are not taxed to you when you close your position. RRSPs turn into Registered Retirement Income Funds, or RIFs, and can produce a steady stream of income in your retirement, hopefully reducing your overall tax burden. TFSAs remain tax-free, even when you redeem from them. Your company may also offer matching contributions to your registered account, usually to a pension plan. If your company offers a matching program, make sure you jump on that opportunity as soon as you can, as it accelerates your wealth building substantially. It's basically free money. As always, there are some downsides. The federal government restricts how much you can put into your accounts each year, so review with your agency to see what your limit is. Another drawback is that if you redeem from an RRSP early, you could be subject to a withholding tax, which is tax paid at the time you redeem from the account. It's something you should be mindful of. If you live in the US or another country, check to see what's available to you for registered plans. I highly recommend them as being the backbone of your investment strategy. Number 6. Term deposits and savings accounts. I don't recommend these products for long-term investing, generally speaking. The returns they produce aren't high, which can eat away at your purchasing power. That said, if you're saving for a short-term goal or putting funds aside for emergencies, term deposits and savings accounts are a great way to put funds away for safety. The interest rates on term deposits aren't great, hovering around 3 to 4% at the time of this writing. Savings deposits run even lower returns, maybe 2% if you're lucky. If you park funds in either one of the options, you either have a short-term goal that you're working towards, such as buying a car or a house in the next year, or you have an emergency fund that you can access on short notice. These aren't useful for long-term investing. That said, if you have extremely low risk tolerance, term deposits can be a useful tool for retirement income, as they do provide stable interest income. Number 5. Precious metals. When times get volatile, investors will seek to get their hands on precious metals, such as gold and silver. Why? These metals have been around for thousands of years and have stable value, regardless of the economy. They provide great protection against inflation and economic uncertainty. Another benefit to them is that they are physical assets, unlike most other assets, which are valid on paper or computer screens. You could feel a gold coin or bar in your hand. While people flock to metals as a hedge against risk, they aren't without risk themselves. If geopolitical issues die down, or there is an increase in supply or drop in demand, prices can fall. There is also no income generation from gold, as it can't pay rent or a dividend out. That said, metals will always have intrinsic value and can bring a negative correlation to other asset classes, reducing your overall portfolio risk. I would recommend exploring investing in precious metals with a trusted professional to see if these assets are right for you. Number 4. Collectibles. A lesser-known asset class in the world of investing is collectibles. Art, unique cars, trading cards, etc. can be an interesting choice for those that want to invest. Collectibles such as art can appreciate significantly, bringing in a good chunk of wealth into your portfolio. That said, collectibles aren't for everyone. In order to profit from collectibles, you need to be an expert in a particular area. If you want to profit from trading cards, you better know your way around a trading card to determine the authenticity of it. You'll also need to know how to price things accordingly, depending on the demand for the card. If no one wants it, your card is worth nothing. This brings another challenge of liquidity. If no one's willing to pay what you're asking for, it's hard to liquidate into cash, especially if you're in dire need of it. If you don't mind hanging onto art pieces or other collectibles for a long time, and are in no rush of cashing them, they could be an excellent option to add to your portfolio. Number 3. Businesses. Most of the billionaires in the world today have built their wealth by owning businesses. They found a problem that millions of people had and created a solution that could be scaled to them. The result was a business worth billions of dollars. While you don't need to create the next Amazon, if you can find a problem that people in your community or region need to solve, and then provide a solution, you too can create immense wealth for yourself while providing a service or good for those that need it. I talk like it's an easy thing, but starting a business is inherently risky, especially if you have little to no knowledge in the field. That's why it's important to do market research to see if your idea is even viable. Once you have some evidence that it works, you can create a business plan to help scale your business. Yes, business is risky. The potential payouts, however, are limitless. Number 2. Intellectual property. Wait, you can leverage intellectual property to create wealth? Absolutely. If you have an idea and you start to make some money off of it, you can gain some kind of patent or copyright on that idea, whether it's a service, good, product, etc. If you manage to gain protected rights to that idea, you can then leverage that idea to others, and you can take a portion of the profits as a fee for them to use your idea. This principle can be used for a product that you've developed, a trademark or brand you've created, or even on music or art that you've created. You can charge a licensing fee for the use of your product to others to use as they wish, and they give credit back to you when they use said product. This area can get a bit tricky to navigate, so I'd recommend speaking to a lawyer about this sort of thing. Number 1. Personal skills and knowledge. I cannot end the video without talking about the most important asset you can acquire: knowledge. If you invest your time into improving your skills, obtaining certifications, enhancing your skills, you will become invaluable in whatever capacity you decide to work in, whether it's at work for an employer or your own business. Take the time to learn and apply the knowledge you gain into your work. Skills can include hard skills such as a trade, marketing, or coding. Soft skills such as communication skills can be transferred from job to job without much hassle. Whatever skills you might decide to learn, they will help you achieve a level of wealth that was previously out of reach for you. Feel free to watch my video on the top 10 wealth building skills to learn. This list of assets isn't exhaustive, but it is a great starting point for wealth building. As you continue your wealth building journey, make sure you include some of these different assets into the mix to amplify your wealth to tremendously high levels. If you enjoyed this video, then be sure to watch my video on how to earn your first $100,000. Thanks for watching, and I'll see you next time.